Hey everyone, Ken McKee here with Canopy Mortgage. Hey, it's June the 15th, and the Fed just raised the Fed funds rate by 0.75%. And you're wondering why I'm smiling. It's because mortgage rates actually went down by 0.25% today compared to yesterday, and probably will be better tomorrow than they were today. So why did that happen? If the Fed raised rates, why are rates lower? Well, because the Fed only raises what's called the Fed funds rate. The Fed funds rate is the rate that banks, like federal depository banks, charge each other for borrowing money overnight to meet liquidity requirements. That's a whole nother video. So bottom line is it does not affect 30-year mortgage rates. It affects things directly like student loans, credit cards, home equity lines of credit, car loans, but it does not necessarily affect 30-year fixed mortgage rates. The reason why the bond market, why rates went down, is bond traders, or we call it the market, the bond market, feels that raising the Fed funds rate by 0.75% is a meaningful contribution to lowering inflation, or shows the Fed is committed to bringing down inflation. So inflation is the number one enemy of mortgage rates. Bonds, though, our 30-year fixed mortgage rates are priced by mortgage bonds. So mortgage-backed securities or mortgage bonds, that directly impacts our rate. And so if a bond is an instrument that has a fixed yield. So it's the same yield, same rate of return over time. And if cost of goods are higher, inflation, over time, but you're giving the same yield out to your bondholder, your investor, the value of that bond is less. The price goes down. So when inflation goes down, the price goes up. More people want to buy it. It creates demand for that bond because that bond's delivering a fixed yield that's higher than inflation, and people make money. So that's a long way of saying that most people don't understand the difference between the Fed funds rate and mortgage rates. And most people out there that were looking at homes, or maybe thinking about looking at homes, just heard the rates went up by 0.75%, and they're like, we were already like on the edge. Now we're going to be priced out. And bottom line is, it creates a lot of opportunities for people who actually know that no, rates didn't just go up 0.75%; they actually got better. And so we're not seeing people right now. We have more inventory now than we saw definitely from last year, and definitely from earlier this year. We're not seeing people have to go in 30, 40, 50,000 over ask. We're not seeing people waive appraisal contingencies. We're not seeing people do crazy things like not asking for any repairs at all for anything. And so, like, we're getting people with 3.5% down, 0 down, 5% down, without waiving their appraisal or going in with any kind of a appraisal shortfall insurance, we call it, where they're offering 10,000, 20,000 over the appraised value to the seller. It's not needed. And we're getting people in every day. And I'm telling you, if you got beat out before, this is your time right now. So bottom line, the great opportunity in the market. Please, if you think that you were beat out and you want to know maybe what it looks like now, give me a call. I'd love to help you out. Please share this with anyone that you know that maybe got beat out before or disenfranchised from the market and just decide to hit the pause button. That's a big mistake. Now's the time to look. There's less competition now than there has been in 2 years. So get out there, start looking at homes. Give me a call, 916-871-7578. We'll take great care of you, and we'll show you how you can actually save more money by our strategic refinance initiative that we have going in our office for next year. So give me a call. Take care. Bye.